What happens when trillions of dollars change hands over the next 2 decades? More importantly, how will the next generation invest that wealth differently? Welcome to today's video. My name is Alfonso Brooks Bay. We're exploring one of the biggest financial events of our time, the Great Wealth Transfer. Financial experts estimate that tens of trillions of dollars will move from older generations to their heirs over the coming decades. This unprecedented transfer is already reshaping investment strategies, financial planning, and wealth management across the globe. In this video, we'll examine why younger generations are making different investment decisions, the opportunities and risks they face, and what these changes could mean for investors, families, and the global economy. If you're interested in investing, retirement planning, personal finance, or building long-term wealth, stay with us until the end. Let's begin. Understanding the Great Wealth Transfer. The Great Wealth Transfer refers to the largest intergenerational movement of assets in modern history. As baby boomers continue aging, significant amounts of wealth, including stocks, bonds, businesses, retirement accounts, real estate, and other investments, are being passed to Generation X, Millennials, and eventually Generation Z. This isn't simply about inheritance. It's about who controls investment decisions. When ownership changes, investment strategies often change as well. Many younger investors have different financial goals, different risk tolerances, and different views about technology, sustainability, and global markets. That shift is influencing financial institutions worldwide. Why younger investors think differently? Every generation is shaped by its experiences. Baby boomers experienced decades of economic expansion, higher interest rates, and traditional investing. Millennials grew up during the internet revolution, the global financial crisis, and rapid technological innovation. Generation Z has never known a world without smartphones, social media, or digital investing platforms. These experiences naturally influence investment behavior. Many younger investors prioritize long-term growth, technology innovation, global diversification, digital financial tools, lower investment costs, greater transparency. They also tend to research investments independently before speaking with financial advisors. The rise of technology investing. Technology remains one of the biggest investment themes among younger generations. Artificial intelligence, cloud computing, cybersecurity, semiconductors, automation, healthcare innovation, clean energy. These sectors attract investors because they represent future economic growth. However, concentrating too much in any one sector increases risk. History shows that even successful industries experience periods of sharp declines. Successful investing often requires balancing growth opportunities with diversification. The popularity of index investing. One of the most important investing trends is the growing popularity of index funds and exchange-traded funds. Instead of trying to pick winning stocks, many investors choose broad market exposure. Index investing offers low costs, automatic diversification, long-term market participation, reduced emotional trading. Numerous studies have shown that consistently outperforming the overall market is difficult over long periods. This is why many financial professionals recommend diversified portfolios built around broad market indexes. Alternative investments. Inherited wealth is increasingly finding its way into alternative investments. These include private equity, private credit, infrastructure, real estate, venture capital, commodities, collectibles. Alternative investments may offer diversification, but often involve higher risks, limited liquidity, and longer investment horizons. They are generally more complex than traditional stocks and bonds. Understanding these investments before committing significant capital is essential. ESG and sustainable investing. Many younger investors also consider environmental, social, and governance factors when making investment decisions. Some want investments that align with personal values. Others believe companies with strong governance and sustainable business practices may perform well over the long term. However, opinions on ESG investing continue to evolve. Investment decisions should always balance personal values with financial objectives and risk tolerance. Digital assets and cryptocurrency. Cryptocurrency has become another area of interest for younger investors. Bitcoin, Ethereum, blockchain technology, tokenized assets. These investments have attracted attention because of their potential for innovation. At the same time, digital assets remain highly volatile. Prices can fluctuate dramatically. Investors should understand both the opportunities and the risks before allocating significant portions of their portfolios. Diversification remains important. The importance of diversification. One timeless investment principle continues to apply regardless of generation: diversification. Spreading investments across different asset classes helps reduce overall portfolio risk. Diversification may include domestic stocks, international stocks, bonds, real estate, cash, alternative investments. No investment strategy completely eliminates risk. However, diversification helps reduce dependence on any single investment or market sector. Tax considerations. Receiving inherited wealth often involves important tax decisions. Different countries have different inheritance laws. Capital gains taxes, estate taxes, inheritance taxes, retirement account rules. Selling inherited assets immediately may create unexpected tax consequences. Understanding applicable tax regulations can help preserve more wealth over time. Professional tax advice may be valuable in complex situations. Estate planning matters. Building wealth is only part of the equation. Preserving wealth requires planning. Effective estate planning often includes wills, trusts, beneficiary designations, healthcare directives, powers of attorney. Proper planning can reduce uncertainty for future generations and help ensure assets are distributed according to personal wishes. Behavioral finance. Managing inherited wealth isn't only about numbers. Psychology plays a major role. Some heirs become overly conservative. Others take excessive risks. Emotions can influence investment decisions. Fear, greed, overconfidence, loss aversion. Successful investors recognize emotional biases and focus on disciplined, long-term strategies. Common mistakes heirs make. Several mistakes appear repeatedly. Selling everything immediately. Following investment trends without research. Ignoring taxes. Over-concentrating in one sector. Making emotional decisions. Underestimating diversification. Failing to create a financial plan. Avoiding these mistakes can improve long-term financial outcomes. Working with financial advisors. Today's financial advisors increasingly work with entire families instead of individual clients. Their role often includes investment management, retirement planning, estate planning, tax coordination, risk management, financial education. Communication between generations has become an increasingly important part of wealth preservation. Global economic impact. The great wealth transfer may influence financial markets worldwide. Changing investment preferences could increase demand for technology companies, innovation-driven businesses, global index funds, alternative investments, digital financial services. Financial institutions are adapting to meet these changing investor expectations. This transformation is likely to continue for many years. Practical strategies for long-term success. Regardless of age, several investment principles remain timeless. Develop clear financial goals. Maintain diversification. Review portfolios regularly. Manage investment costs. Understand taxes. Avoid emotional investing. Continue learning. Focus on long-term growth instead of short-term market movements. These habits have supported successful investors across multiple generations. Final thoughts. The great wealth transfer represents far more than inherited money. It represents changing perspectives, changing priorities, changing technology, and changing investment strategies. While younger generations may approach investing differently than their parents or grandparents, the foundations of successful investing remain remarkably consistent. Diversification, discipline, patience, education, and long-term thinking. The next generation of investors has unprecedented access to information, technology, and investment opportunities. How they manage inherited wealth may shape financial markets for decades to come. If you found this video informative, consider subscribing for more content covering investing, retirement planning, personal finance, and long-term wealth building strategies. Thank you for watching, and we'll see you in the next video. The information provided in this content is for educational and informational purposes only and should not be considered financial, legal, or tax advice. Always consult with a qualified financial advisor, tax professional, or legal counsel before making any financial decisions. The creator of this content is not responsible for any actions taken based on the information provided. Investments and financial decisions carry risk, and past performance does not guarantee future results.